What's going on, everyone? Welcome to Real Talk Real Estate. This is Mortgage Monday. I'm joined with Christian Batchelder, the broker, owner, and my partner in TheOneBrokerage. We're kicking butt and taking names, and we're here to talk to you guys about what the government shutdown might mean for the mortgage industry. Christian, how are you today?
Pretty good. It's funny because probably by the time people are listening to this, maybe it'll be back open depending on how long it takes. But definitely, I think it's important to address the elephant in the room of government shutdown last night. So we're recording this October 1st. We got the news that budget was not agreed upon, and we are officially in government shutdown.
Yes, sir. This is a very interesting time to be in finance, whether it's strangling our own economy by increasing interest rates and having a hard time getting people to go back to work, the tariff situation, now a government shutdown, in between all of the talks of wars that are going on and bombings and like just insanity in the world. It's definitely not really ever a slow news week. So, and that's not even mentioning the Charlie Kirk stuff. So let's talk about what a government shutdown can mean for loans. But before we do, let's talk about TheOneBrokerage a little bit. How are things going over there? How many loans do we have in submission?
Yeah, we have quite a few, multiple hundred right now. We eclipsed over 200 currently processing, which is very good numbers for, we're a large size brokerage, but still in the grand scheme of things, we're not Chase or Wells Fargo or Rocket Mortgage, right? I mean, they'll do thousands in a month, but very good volume for who we are in the, sector of the economy that we're in. Obviously, a little bit of a kick up in refinance applications. Even in a lot of new primary purchases are kicking up with a little bit of the rate, easing that we've had. Much needed, in my opinion, right, in the industry to get a little bit of relief on these interest rates. And it's causing people to respond, which is great, right? It kicks up opportunities for savings for people on the refinances of their mortgage. It kicks up new home buyers, which, may ease a little bit of the burden on sellers that were just sitting on properties that don't sell at an 8.5% rate, right? So I think it's overall a good thing. Rates are a commonly discussed topic, especially these last 2 or 3 months on Mortgage Mondays and just in general. And I believe we're getting some healthy cracking so that we can get some much needed relief that really honestly been waiting for what 2 years now for some rate relief, right? And it's finally starting to come, which is good.
So if you're listening to this and you're sitting at an interest rate of 7% or higher, I need you to go to davidgreene24.com and use the chat option that or contact us, and you'll get a hold of me directly. I will put you in touch with Christian. We will look into how we can save you some money on your loans, and if now is a good time for you to be buying. And if you are a mortgage loan officer and you want to be a part of a company that is chasing down Wells Fargo, Chase, and Rocket Mortgage, we can only do it if we get more people working for us. We have too many loans and not enough people to handle them. So we would love if you would come hang your license with us. Christian and I will be your leaders and give you training ourselves and what you can do to be a more efficient loan officer and serve the people better. So whether you guys need a mortgage or someone that works in the mortgage industry that needs a better broker to work for, we would like both of them. Christian will give his email at the end of the show. And as you're listening to this, please just pick up your phone, go to davidgreene24.com, hit that chat button and just be like, hey, I'm listening to your podcast. This is what I would like help with. We'll get you connected. Now, this is pretty interesting because, as you mentioned, rates went down. I've seen an uptick in buyer activity. I put 2 of my own houses, almost 3 under contract that have been sitting there for 6 to 9 months or so that haven't been under contract at all. Boom, they just went under contract as soon as rates went down. So I can only imagine what it's doing for the market as a whole. Like you said, our loan applications are up. And now they're shutting down the government. So we're going to talk about what that might mean for the mortgage industry right now. First off, we've got an article here out of Realtor.com. It says the federal government has halted most operations for the first time in nearly 7 years, a move that will have ripple effects through the financial markets that determine mortgage rates. The shutdown began at midnight on Wednesday after Republicans and Democrats in Congress failed to reach a deal on a new spending bill to fund federal ops. At Wall Street's opening bell, the major stock indexes opened slightly lower, all losing less than 1%, while long-term bond markets saw a moderate decline in yields, easing recent upward pressure on mortgage rates. During a government shutdown, hundreds of thousands of federal workers are placed on unpaid furloughs, which can slow economic growth. Typically, the effect is temporary, and most of that lost growth is regained when the shutdown ends and furloughed workers receive retroactive pay. However, this shutdown comes at a time of heightened economic insecurity, with recent federal reports sending mixed messages suggesting overall growth appears strong, while the labor market seems to weaken. The Fed Reserve's next decision on rates later this month hinges on how those trends play out. But during the shutdown, the government will cease issuing crucial reports on inflation and the economy, including the highly anticipated monthly jobs report that have been due on Friday. This leaves the Fed policymakers and the investors who ultimately determine mortgage rates groping in the dark as they try to assess economic conditions, introducing new uncertainty and volatility into the market. Christian, let's talk a little bit about this. How would you predict that a government shutdown would affect rates? Will they go up? Will they go down? Or will they stay the same?
Yeah, good question. So, I mean, this article kind of alluded to it, but government shutdowns are typically, ideally, right, a very short term thing, right? Usually it's a week or two. We figure it out. They come to an agreement. Somebody, right now, the right and left, House Republicans and House Democrats they're basically arguing not really anything mortgage based, but they're basically arguing, the main contest has been over healthcare, and a lot of the things in the big beautiful bill the Democrats are trying to walk back a little bit. Regardless of your stance or where you land on the aisle, we're all impacted by the financial industry, right? Mortgage rates infecting anything from, even auto loans, right? Credit card rates, all of them are kind of in that same bucket together. But in general, historically speaking, a government shutdown is typically, at least in the short term, helpful for mortgage rates. To understand that, we're going to deviate a little bit from what we've discussed previously with like the Fed and the CPI and a lot of things that we've discussed in the previous episodes of Mortgage Mondays, and instead just kind of rely on the basics. In any times of uncertainty, right? War, economic events like COVID, government shutdowns, the big beautiful bill, right? Anytime there's something new that's uncertain that causes concern, people will typically retract from their investments in more growth-minded things like the stock market, things like, mutual funds, the things that usually have a higher rate of return. Mm-hmm. They retract from those, and they will typically retreat into more secure investments. Those are typically bonds, mortgage-backed securities, things that pay a lower yield, but they are more stable. Okay. Mm-hmm. Obviously, with a surge of buyers going into those more stable assets, mortgages being one of them, that will typically drive the cost down. There's more buyers, so the cost up, but mortgage rates are inverted. So that means the yield goes down because there's more people interested in it, so they're willing to accept being paid less. And all in all, basically what that means is that a surge in people interested in buying bonds will have downward pressure on mortgage rates, right? And the 10-year treasury yield and everything that drives them. So ultimately, my one sentence answer, right, after my 3-paragraph monologue there, is that it should be helpful, at least in the immediate short term.
Here's what I heard that I think was most important here. Most people that are tracking mortgage rates aren't really aware of what makes them go up or down. They just know if they go up or down. But it's very helpful to understand exactly what you said. In my mind, I sort of see this image of money that moves like water. And water tends to go wherever the downhill road leads it. It doesn't think on its own. It just moves in whatever the most downhill direction is. So if you want water to move, you dig a ditch, you dig a trench, or you raise where the water is, and you can determine which way it's going to float. Money does that towards like yield. Wherever it thinks it can get the best yield for the lowest risk is where money's going to go. When people feel really optimistic about the economy and they think it's going in a healthy direction, they are going to sacrifice security and safety in exchange for risk and yield. When people feel the opposite and they're scared, they sacrifice risk and reward for safety and security. In an economy where people think, oh no, there's a government shutdown, we could be going to war, we're going to be facing a recession, the government has cut back on stimulus and has instituted quantitative tightening, all of these things that you hear, like when the government is trying to put the brakes on the economy, which is usually due to inflationary concerns, but it could be a lot of different things, money flows to safety. And what you're saying is mortgages are considered on the safer end of the spectrum compared to other investments like stocks or some of the other high yield stuff, correct?
That's correct. Yeah, and with that shifting towards them, basic rules of macroeconomics, supply and demand, there's now more demand for rates, which means they can get people to buy them paying out a lower yield, right? Same concept of anything. You can get a better deal the more people want it, right? Mm-hmm. As the seller, right? Like you're selling houses, you can get more money. People are willing to pay more money if there's a bigger surge in buyers, right? That's the always shifting buyer seller demand. And same exact thing happens for mortgages. Even though they're not buying houses, they're buying debt, basically, right? That debt is capable of paying out a lower return the more people are interested in buying it.
Yeah, that's a great point. We tend to look at mortgages like, hey, where are rates? If they're low, I'm more likely to refinance. If they're low, I'm more likely to buy. But we don't think about the fact that the people lending the money are looking half at us and they're looking half at who they're going to sell the loan to. They got to figure out, well, who's going to buy it? After we decide we're going to buy it, they got to sell it to somebody else. And I think lenders in general want to be able to give low rates, because if people will buy a loan from them at a low rate, they can sell more of them, right? Assuming that all things are equal and they're making the same on a loan, because we know that they make more when rates are higher, but they also do less of them when rates are going to be higher.
Exactly right.
So if they can get rates, if they can get someone to buy when rates are low, they can sell a higher volume of loans. Their staff can make more money. Their employees can be more happy. They can offer incentives to people. Let's say that there was a certain number of people who were going to buy a house if rates were at 8%. Well, if rates go to 6% or 6.5%, more of them theoretically are going to buy a house. Well, if you could throw onto that, if we get rates to drop from 8 to 7.5, there's a sliver of people that might refi. But if we can get rates to drop from 8 to 6, there's a lot of people that might refi. That is a lot of loans that we can now go sell, in addition to the more houses that are being sold. So I tend to look at lenders like they would like rates to be low. They're not the ones saying, no, we want rates to be high because we're greedy. It's the people buying them that are making that decision. And they're making that decision based on what other things they can buy where they might get a yield. And do you want to share what like the biggest competitor for mortgages tends to be in the market where people are buying them?
Yeah, I mean, mortgages get built in. I'll just basically split it up into two. There's growth-minded things, namely the stock market. That's the big one, right? And then there's those safety-minded things, which are bonds, mortgage-backed securities, treasury bills, that are more so on the here's a fixed return. A 30-year mortgage, like it doesn't have a possibility of like really giving you a huge return. Like if somebody has a mortgage at 6%, it's not like, oh, if the market does really good that year, I may get 9% return. No, you're going to get 6. But it's guaranteed. I mean, it's as close to guaranteed as financial investments come. Like outside of like the 2008 crisis, like the foreclosure rates are pretty low across the board, right? Obviously, there's always some risk with anything. That's why you get some return. But it's not like, Elon Musk can go and make some decision and Tesla stock could tank by 15%. Like that also can't happen with a mortgage,
Mm-hmm.
right? So these investors that if they are retracting and they don't want to be subject to the volatility that a government shutdown might bring into the conversation in the stock market, that's why you see that retreat to more guaranteed bonds, treasury bills, T-notes, mortgage-backed securities, right, that dictate rates.
There you go. Great point. So mortgages tend to track with those 10-year bonds and treasury bills, which is odd to me because there's more risk with the mortgage. But I think the way that they look at it is foreclosures come in big gluts. It's not, I mean, you get a percentage of them that are always going to foreclose just from the person who lost their job or managed their money wrong. But I think most mortgages come when you have or foreclosures come when you have the perfect storm. You have a weak job market, you have consumer debt that's high, you have people's reserves have run out. So the economy has been weak for a consistent period of time where they built up their debt and they've used up their reserves. And then you get the housing market goes down. If like all 4 of those things happen at the same time, that's when you're likely to see foreclosures because people feel like there's no way out. If only one of those things happens, you don't see a whole lot of foreclosures. If housing prices drop, but the labor market is still strong, that really never happens. But if it did happen, not a lot of people would foreclose.
And just to give you an idea on numbers here, I mean, I literally just Googled as you're talking, David. The average, I think it would shock a lot of people because they think, oh, one of the scary things about owning real estate is foreclosures. The foreclosure rate between Fannie Mae and Freddie Mac in the fourth quarter of 2024, they release yearly numbers, so we don't have fourth quarter this year yet. So just taking the most recent one, 0.57%. So that's half a mortgage.
Half of a percent, yeah.
Like it's not enough to move the needle for investors to say I don't want to buy this asset. Like that's a very, very low fail rate, which is why everything that we're saying is based in the opinion that mortgages and this style of investments are secure. You have less than 0.5% default rate, right? That's really, really, really good.
Yep. There you go. And I can't tell you how many YouTube channels there are out there that put up the fire emoji, or not emojis, but like the fire thumbnail. And it's all coming down. And they get up there, they scream about these Airbnb reckless people ruin the market. And Trump is screwing everything up again. It's always a worst case scenario. Foreclosures are coming in waves. And they scream this for 20 years. And then you finally have recession and they go, I told you so. But meanwhile, the 20 years of screaming, no one ever holds them accountable. It can happen. But as you said, the smart money tends to think of mortgages as a safer bet. Now, I got another article.
When they misdisclose the data and they say, oh, there were 10,000 foreclosures in the fourth quarter, but you don't account that there were like 10 million loans given. Right? It's like, sure, yeah, 10,000 sounds like a really big number, but like when you consider it a ratio of the mortgages out there, it's like I said, it's a 0.5%. It's like almost nothing, right? But you can skew all sort of data with the way that you put it out there, of course. But I always find a crack at that because it's like put it on a chart, like put it on a graph. Let me actually see what that looks like, and it's very minimal, right?
All right, so this article out of where are we here? About the federal government shutdown needs for the mortgage industry, MPAMAG.com talks about which agencies will be affected by the mortgage industry the most. So the Consumer Financial Protection Bureau has people that are on pause right now or on furlough. That's a fancy word. The Department of Housing and Urban Development, this is HUD. So this is where the Section 8 housing program comes from. I believe this is also where like the Federal Housing Administration sits underneath, which is FHA. Yep, there it is, part of HUD. So that is confirmed. FHA sits underneath HUD. Department of Veterans Affairs, which I do not believe sits underneath HUD. But when you hear people say a VA loan, all that means is a loan that goes through the Department of Veterans Affairs, which is odd to me that they have like part of the people that work there have to learn loans and part of them have to learn like PTSD counseling and part of them have to learn like prescriptions and medicine that are given out.
Yeah, but that's like a whole economy just in of itself.
That's exactly right.
Like a country by themselves that they run just for veterans.
It does not seem very efficient. It would make more sense to have like one government agency that understood financing and then they had like requirements for VA loans and that people knew it. And those were the same people that knew the FHA requirements. But I mean, that's efficiency and then it's not something that the government does well. Although I did hear Trump threaten that if the Democrats don't meet in the middle or whatever he's trying to get him to do, I don't know the details of it, but I heard him say, maybe we'll just start laying everybody off. Maybe we'll just start getting rid of these jobs and there won't be any job to come back to and we won't have to worry about this. You heard that too?
Yeah, I did. That's I think that's a bit of a front, but definitely one way to address the situation is just hey, turn your furlough into a layoff, right?
That's it. Yeah, I guess his lawyers looked into it that they have the authority to lay people off to get the budget like where it needs to be so that they can restore Congress. The Internal Revenue Service, which processes tax transcripts and verifications, which are required for mortgage applications. You want to talk briefly about how the IRS is involved in the mortgage approval process?
Yeah, so like if you're getting a standard, traditional, conventional mortgage, right, you have to provide us your tax returns. We don't just believe your PDF though, right? I think a lot of people may think that like, oh, you're asking for all this stuff from me. Correct, but we also verify it. And the IRS has a tax transcript service where we get your taxes, your PDF that you sent us, and we confirm that you didn't, get real creative in Adobe and add a couple zeros onto your income, right? So we match your taxes that you hand us versus what you actually filed to the IRS. And believe it or not, guys, I've seen everything. I have had tax transcripts come back that do not match the PDF that I was given.
Ooh.
It happens.
That's scary.
You'd be shocked. We do the same thing with bank statements, right? If you send us a bank statement, typically the lender has a built-in, it's called a verification of deposit, a VOD, where they'll call your bank and confirm, hey, on September 29th, can you confirm the borrower had $50K in their bank account? I've had those not match. Believe it or not, people still think they can get away with so that you guys understand, that's mainly what happened in 2008. People were literally photoshopping bank statements and there was not a verification service input. That's why people called them like ninja loans, no job, no income. That's because you could put whatever you wanted on your mortgage application and nobody would verify it, right? That does not happen anymore. And the people who do it, they get caught and they get in trouble. So if you're thinking about doing that and it's as easy as PDF editing a couple zeros on your income, I can promise you it will not work. There are systems in place to protect against it. The IRS tax transcript portal is one of them.
So that's scary stuff. Don't Photoshop your bank statement and give it to us and just don't tell us about it. Well, actually, we appreciate the fact you didn't tell us that you lied because we don't want to be involved in that. But don't do that either because someone's going to go check and see 100%. If you actually made the deposits that you said you did. And you don't want that knock from an alphabet agency. So those are all agencies that are going to have furloughs, which could slow down our job as the people who are trying to approve your loan. Now, for the Consumer Financial Protection Bureau, this article says that there could be some operations that are affected or shut down, although that is probably minimally going to be affecting mortgages. But other things will be. So FHA and VA loans, the processing and the underwriting of new FHA and VA loans may be slowed down if there is a reduction in available staff or if certain operations are suspended. That could lead to delays in approvals and closings. Christian just mentioned the IRS tax transcript. So as we are verifying that the taxes that we receive from people applying for loans, whether that's a refinance or that's a purchase, can be slowed down. It says that's the 4506T form. I'm assuming, Christian, that is a number that you hear quite often.
Yeah, that's just the form that we send the IRS to verify that what you gave us is true.
Yeah, it also sounds like the bad guy in the new Terminator 3 movie that's going to be coming out. The T4506. If the Bureau of Labor and Statistics is unable to release scheduled economic reports, this is inflation or jobs data, market volatility could increase, and lenders may have less information to guide rate decisions. One such BLS announcement is due this week, but now is unlikely to arrive as scheduled. And then rural housing loans. The USDA's Rural Development Loan Program may see significant delays as the agency typically ceases processing new loans during a shutdown. Christian, how often are we doing these USDA loans?
Not very often. It's a niche product. It's good for people who want to buy a primary, out in the boonies a little bit, right? It's a cool loan product, 0% down. We definitely do them when they come through. We are fully approved to do USDA loans. Just typically our clientele, there's a couple lenders that's all they do, right? Like they specifically set up like a local branch location out in like rural Kansas or something, right? But there are specifically designated rural tracts of land. If you're in a main city, it's probably nowhere near you. So for the vast majority of borrowers, it's not even an option. And you also have to live there. So a lot of people, they don't want to live in, a rural area, right? A lot of people want to invest there, but the USDA loan does not have an investment property loan. It's only primaries. So here and there, David, here's the answer. Definitely not one of our core products, though.
Okay. I have a question unrelated to the government shutdown, but this is something that I hear a lot. There are people that are under the impression that if they want a VA loan, they need to go to a VA lender. They want an FHA loan, they need to go to an FHA lender. If they want a DSCR loan, they need to go to the specialist. And they'll ask people, who do you know that does USDA loans? Who do you know that does VA loans, etc.? What advice do you have for how people should think about this? Are they thinking correctly that they need to ask around and find a lender that does those loans? Or should any loan officer worth their salt be able to do the different types of loans? And if that's not the case, is it a good sign if the loan officer can do more than one loan or a bad?
Yeah, it's a super good question. We actually are in that spectrum as well, where people think we only do investment loans. Yes. I've had so many borrowers who come back to us that say, I'm looking to buy a rental and I just bought a primary. I'm like, oh, why didn't we help you there? You guys do primary resident? It happens all the time. So if you guys are watching this, first and foremost, OneBrokerage does everything. If it has to do with mortgages, we do it. HELOCs, commercial, DSCR, bridge, hard money.
The OneBrokerage that does it all. It's in the name.
Yeah, literally, guys. That's why we call it the OneBrokerage. So kind of your one-stop shop, so to speak, right? But to answer your question clearly, there are lenders that have hyper niche specialties, things like you hear like first responder, doctor specialist type loans that you may get a benefit from going in direct lender. But in general, there is not a lender that does only FHA loans that does them better than us. Like you can make the jack of all trades argument. We're a jack of all trades and we know how to do them well because we have spent the time, the effort, and the energy to learn them. We do that. We do FHA all the time. We do VA all the time. And usually, guys, we can beat the retail guys. So I have a lot of quotes that come back from Navy Fed. Navy Federal is probably, I haven't looked at the numbers, but probably one of the top 3 VA lenders in the country. They've kind of established that brand. They're the VA lender. I beat their quotes every single day, every day. And we do it quicker and more efficient than them as well. It's just part of what having, a small business, broker owned, loved and nurtured company versus a big corporate enterprise. We can just operate at different margins. We can pass along that savings to the borrower. And ultimately, the ideal is to give you better service as well, right?
Well, next week, we're going to break down how the one brokerage is literally structured that makes us so efficient, like how we have the jobs delegated and the assembly line put together to be really fast. But I love your point there that it's really a marketing tactic. When a company says we do VA loans, they just know veterans hear VA and go, oh, I'm going there. And that's like, because they're not that good, they need a gimmick. And so they advertise themselves as the VA loan or the FHA person. But you're saying, if you have a loan officer that holds themselves to a high standard, that loves their job, that's passionate about what they're doing, it's, I don't know, maybe this is a bad example, but if like you're in the military, you shouldn't be like, oh, we only shoot AR-15s. We don't know how to shoot a handgun. Well, you might need one at some point, right? You should probably be practicing with both. And if you want to be a good soldier, you're going to be able to use more than one weapon. If you want to be a good loan officer, you need to use the different loan projects at your disposal to solve the different problems that your clients bring you.
It also gives you flexibility, because like if a borrower comes in and says, we've had this so many times. Borrowers come in and they say, I'm pre-approved for a FHA loan, I'm rate shopping. And because we also do conventional, I give them a quote and I say, hey, if I can get you a much better deal, a better rate, a better monthly payment on a conventional loan, like, would you be open to it? And they're like, oh, I was just told FHA is the best first-time homebuyer loan. And I'm like, well, that's BS. First and foremost, like, that's not true at all. It's a good first-time homebuyer loan, but it's not the best, right? Like, here's your other options, and I'll put two options in front of each other. Well, if they were working with a lender that was laser focused on FHA, you wouldn't have had that conversation, right? Yeah. And even getting into like the scaling and operations, like if you want to buy your primary and have your FHA lender, and then eventually convert to conventional and have your conventional lender, and then, oh, I want to buy a rental, so I need a DSCR loan, I need to go over here. Oh, and then I want to fix and flip a property, so I need a hard money lender. Why are you doing all that? Like, if the rates are very competitive and the service is similar, why not just have your core group? It's like, do you want a different property manager for every property? Like, probably not. Ideally, you want to get one guy who can manage your portfolio. He's familiar with your bank accounts. He knows your utilities. Like, if there's a problem with the property, you're hearing from the same dude every time. Like, that sounds better to me. But, ultimately people make their decision and they do fall victim to the marketing tactics. But yeah, I feel very confident with our ability to, if it has to do with a mortgage, we know it well.
Yeah, I don't think I understood when I was new at this. Like when I was first getting my real estate license and selling houses with Keller Williams, I didn't know any of that. I didn't understand it was all marketing. I didn't know when they said first time home buyer programs that was a marketing tactic to get you to go to them, but that they didn't do anything different than anyone else. They just talked about it better, right? Or if they were like, we have loans specific for bilingual people, you're like, that just means we have a loan officer that can speak Spanish. There wasn't some super secret squirrel stuff that they had that other people did.
It's like Honda saying we sell 4 tires. It's like, we have cars with 4 tires. Like, I bet you do, but so do Toyotas, right? Like that, it's the same concept, but they're just making the active effort to market and say, buy 3, get your 4th tire free. Well, like every car comes.
Or our car comes with a spare tire in case you need.
Exactly right.
They're not telling you that every other car does too. They just did a better job. And if you happen to be a person who just had a flat tire, like I'm sick of this, I'm going to that place. No one told you that 10 years ago they didn't put spare tires in cars, but now they all do. That's why we're here to share this information today. So like I said, next week, we're going to be doing a breakdown of why our loans get done faster and quicker. You did make me think of an analogy though. When you mention the person who comes to us and says, I just did a primary, now I need an investment loan. Folks, if you are listening to this, I'm going to be straightforward to you. This is how this feels. This feels like when you really like a girl, but you're not sure if she likes you back. So you're trying to be really respectful and you don't want to like push her away by saying you have feelings for her. Ladies, I don't know if this is a thing you guys go through, but Christian, I'm sure you can agree as a man, this is a really hard problem for us is like, we like you, but we don't want to ruin the friendship. So we don't say anything. We just wait to see like, is there a sign you like me too? And we're not saying everything that we can do. And you probably have no idea on the other side. And you like, hey, can you give me a ride to get my oil changed in my car or something, or can you help me pick up my car? It's in the shop. And we're like, yeah, of course I can do that. And they're like, thanks. My boyfriend crashed it last weekend and I'm single now. And we're like, what? You have a boyfriend? Like, yeah, why? You're like, because I've liked you this whole time. And she's like, well, you didn't say anything about that. I didn't know that you liked me. I just thought you wanted to be here to hear me complain about what I was unhappy about in life. You're like, no, I was willing to do that. But what I wanted was to be your boyfriend. We want to do your primary residence loans because, to be straightforward, they are a million times easier and more fun for us. We get to be a part of changing your life, being involved in where you're going to live, making sure you get keys. The loans themselves are easier and less stressful, so we can spend more time getting to know you personally. Most of the investment loans are tougher, not as profitable, and a lot more stressful. There's more moving pieces, and that's why we're very good, because we do that more of the time. But please, when you want to buy a house, please come to us. We want to be a part of it. We want to give you a present. We want to get to know you. We want to build a relationship with you. We want to be there to refinance that thing. We want you in our database so we can tell you when it's a good time to refinance it. We want to be your boyfriend. That's what we're trying to say, especially Christian. I would like to help you guys get married. Maybe I could be the priest in the wedding. But yes, we want to be your boyfriend. We don't want to be in the investment zone, which is where we can often get put. And this is me coming forward with my feelings and putting them on the table and saying, you listener, I like you. I've always liked you. I have special feelings for you. And I would like a special relationship with you. I don't want to just be your podcast. I want to be your mortgage broker. And I want to be the best dang mortgage broker you've ever had. How'd I do, Christian?
I love it. I was about to say I do right there.
Sometimes you just got to share your feelings. You can't worry about rejection. You got to put it out there.
Till sale do us part.
Till sale do us part. Or a refinance, either way, right? We'll just renew our vows. That's what a refinance is.
That's a refinance.
A renewal of our terms. And it's going to be even better for you. You get a bigger ring. You get a sweeter boyfriend. We're going to be better, or a sweeter husband in the future. You get even more. All right, Christian, if people want to reach out, they want to get a hold of you, they want to talk about if they should refinance their house or if they should buy a property, where can they go?
Yep. OneBrokerage.com, TheOneBrokerage.com, sorry, is our company website. You can find out more about what we do. You can see all these loan products on our loan products page that we talked about today. Fun, actually. We're rebuilding our site right now to be more user-friendly, easier to get in touch. David's got a fun project going on that, so you'll see that go live here shortly. If you want to catch me directly, Instagram's the best place. I'm at TheOneBroker with underscores between the names, or _1_broker. Send me a DM anytime. I respond to them as quickly as I can. We'll get on a call. We'll talk about your scenario.
There you go. You can find me on Instagram at DavidGreene24. There's an E at the end, and look for the check mark. Christian's got it as well, because there's scammers out there pretending to be us. And also, make sure you go follow me on Facebook, because we're going to be running One Brokerage ads to people, and I want to make sure that you guys see it if we're friends. So if you've been listening to this and you're like, I had no idea that David felt that way about me. I thought he was too busy for me. I didn't know he wanted to be my boyfriend. I do. Go to davidgreen24.com, send me a message. Let me know you'd also like to be my boyfriend or girlfriend. And we will get into a formal, serious relationship with you and see what we can do to bring value into your lives, your businesses, and your portfolios. Thank you guys all for listening. Christian, thanks for being here. We will see you guys next week on Mortgage Monday.